Hello and welcome to Sectors Up Close. I'm Ramzan Karmali. Today we're going to discuss the outlook for major banks with Steve Sosnick, Chief Strategist at Interactive Brokers. Higher interest rates and an uncertain economic environment are casting a cloud over US bank earnings, with the second quarter reporting season kicking off. JP Morgan Chase, Citigroup and Wells Fargo will report second quarter earnings on Friday. Goldman Sachs and Bank of America report the following week. It will likely be a mixed picture, with JP Morgan and Bank of America forecast to report falling profits, while Citi and Wells Fargo may report an improvement. Executives' commentary on the path of interest rates will remain a key focus, especially after industry leaders cited improving conditions for investment banking. So what is the outlook for the sector? Well, let's ask Interactive Brokers' Steve Sosnick. Steve, thanks so much for joining us. Well, let's start with that thought. What's your outlook for the whole sector, Steve?
Good morning, Ramzan. Well, the key here, of course, is how do we define the sector? So we're going to define it as big banks because, or the so-called money center banks, because, the banking sector itself is really quite heterogeneous. You've got everything in the U.S. from the tiniest minnows to the biggest fish in the pond. And so thinking in terms of the big money center banks that are coming out now, I think it's going to be a testament to each company's management to see how well they can navigate through the current environment, because each of them has a big series of opportunities and challenges. Whether it's the inverted yield curve, whether it's the reliance on the consumer that may or may not be slowing, and of course commercial real estate, which sort of hangs out there like a big cloud over a lot of these banks. On the other hand, they have been able to manage their businesses pretty well, at least the better of them. Let's see what they can say in the next week or two.
Well, let's look at those big lenders. If we look at the banks as measured by the 13 constituent S&P 500 bank index, they've done pretty well, up 35% over the past year. They've benefited from a high interest rate environment. What's going to happen when rates start to come down, though?
Well, part of it depends on how they come down. If they come down in the short end and the front end of the curve, that's probably good for banks because an inverted yield curve does pose a bit of a challenge. Remember that the basics of banking are that you borrow short and lend long. And so if you're lending long at, in theory, a lower rate than you are borrowing in the short term, that's a big problem. Most of these banks get around it because they don't necessarily pay the most competitive funds rates, because certainly in the largest cases, there's almost a too big to fail premium, so their deposit rates can be a bit lower than what you might get at a less well-known institution. Also, because of credit quality and stuff, they're not lending money at the rate, at a 10-year Treasury rate. They're lending it at a spread. So it's a headwind, but not terrible. But this will be the key. So it's not necessarily it's less dependent upon the level than the spread and their ability to pass on either lower rates or higher rates, depending on whether they're borrowing or lending.
Steve, let's look at earnings estimates, analyst earning estimates now, and the wider S&P 500 Financial Index. We have forecast earnings growth of 8.8%. Sounds good, but compared to the wider S&P 500 of 10.6%, and you look at communications above 21%, healthcare above 20%, is this discrepancy likely to continue? And what does it say where investors should be allocating?
Well, I think in the short term, it says that banks are not your AI darlings, but in the longer sense, when you think about the sort of the stuff we'd made comments about earlier, the inverted yield curve, et cetera, they're actually doing a pretty good job to get high single digit earnings growth. That's in any normal environment, that's actually a pretty pretty good thing, pretty desirable. Obviously, on a relative basis, you understand now why tech is just dominating. Um, the there's the short term and the long term, and of course the short term, the immediate we've gone over, and so the question then becomes, do you see the rate? Do you see the rates normalizing, and how quickly? Fed rate cuts and the like would be one of the simpler ways, certainly the more beneficial way, rather than having the yield curve normalized by having the long end go up, because that wouldn't necessarily be good for the assets that they're holding, on a mark to market basis at least. And so uh, It's not a bad sector if you believe in the thesis that the Fed is going to be cutting rates, that you do have a soft landing, which I think is key. You can't have anything much worse than a soft landing right now and be favoring banks. But there are reasons to be looking at them. To me, the real value of earnings season for banks, of course, is if you own one of them, you want to know how they're doing. But you also want to listen to the conference calls from the CEOs and the like to find out what their customers are doing. Because the great thing about bank earnings calls is these big banks have have their tentacles all over the place in consumers in large companies and mid-sized companies, et cetera. And you want to get a sense of how those companies are doing. And if they see challenges among their best clients, well, that might not bode so well for earnings season or for the guidance that will come from earnings season. So you really want to you these are crucially important earnings, but not in the sense, of doing the scorecard of X number of company, six of the banks beat their earnings or two of the banks missed their earnings. That's not to me the interesting part. The interesting part is what it tells you about the earnings season to come.
Steve Sosnick from Interactive Brokers, many thanks for your thoughts. And that is your look at US banking sector. I'm Ramzan Karmali, and this is Reuters.